Prateek Agarwal joins us now, Chief Investment Officer with ASK Investment Managers. Prateek, good morning and good to have you back. Prateek, it's been a one-way street for Indian markets. Do you think we've got all the ingredients of a bull market, or what has happened in last 2 or 3 weeks is a simple extension of the trading range? We are nowhere close to a bull market.
No, I would be a skeptic here. I really don't believe numbers or the environment support runaway bull market. Valuations on the main indices are looking stretched. We have had the result season which has been better than expectations for sure, but a very large part of the beat is mainly on account of rupee dollar volatility and the benefit that it has brought to a lot of export oriented businesses and businesses which can price on import parity basis. In terms of unitary sales growth, there hasn't been much. We continue to be skeptical. Going forward, my sense is the mix in the result season would turn towards more bad rather than good. And with valuations where they are, I would tend to believe that we have sideways to down markets rather than up markets. That besides this, even globally, if people are again starting to talk of taper sometimes over the next 2 months, 3 months, and once again, having to deal with debt ceiling in the US, the global cues cannot be good over the next 2 to 3 months. So all said and done, my take would be that we stay where we are or we move down a bit.
Are you sensing that the market will face resistance or pressure at the higher levels around 6,300, 6,350 thereabouts?
No, okay, this is a slightly difficult one. I tend to look at the markets in two parts. One, where earnings are increasing. They have been increasing in the past, and there is visibility of businesses delivering growth in the future. There, if the stock prices have moved in line with the earnings, we feel comfortable. Most of these places, we have seen stock prices move in line and maybe slightly more than the earnings growth, and still there is no cause of concern. The challenging part is the part where earnings growth is not happening and stock prices have fallen. There, if you start to look at where the stock prices were before and where they are today, not looking at the earnings, one tends to believe that this is a cheap part of the market and one should be there. But as soon as we look at earnings as well, we find that earnings have also crapped out, and maybe the outlook on the earnings is not as good either. This is a space where market keeps moving between hope and despair. When there is hope on account of various counts, maybe cheaper money, maybe global liquidity, maybe a better political climate, maybe more reforms happening, we see reflation, and when that hope dissipates, we again see some amount of turbulence. The other part is the part where earnings are compounding. That is much less volatile.
Prateek, so according to you, if the fundamental picture is not strong, why is the technical setup for Indian markets very strong and encouraging? Markets are not reacting to bad news. Mid-cap stocks have stopped falling. Cyclicals have made a comeback. The list of new highs on a daily basis is increasing. So my question is that if market fundamentals are so bad and so poor, why is the technical setup so appealing?
No, you have added so to everything, so it tends to look extremely bad. But there have been some improvements. Let's say 3 months back, we were really worried about the current account deficit. Now that is a part which is clearly under control. Last 2 months numbers have been very good. If you look at how people have behaved in the interim, when rupee was weakening as a consequence of bad CAD, let's say ETFs overseas may have taken some money off the table, because that's one way of generating alpha in an ETF kind of a vehicle. But then when rupee bounced back, and along with them the market, those guys who had cash on the sidelines really had to pump back monies really quickly. I think that really resulted in markets overshooting the range. That is my sense. I think that bit of trade is coming to an end. Maybe some bit of momentum chasing monies may have got associated because of the momentum that the markets have shown, but overall we really believe on the index market is looking pricey. If you again start to look at the mid-cap part, and you said overall number of stocks doing highs are larger than number of stocks making lows, well, the mid-cap indices are 30-40% lower than the highs registered sometimes in early 2008. So there, if some stocks are doing better over the last 52 weeks, really doesn't mean that it's an exuberant bull market. Once again, if you look at the composition of those stocks, the good quality names with, let's say, an ROC of over 25%, which can sustain growth of over 20%, is the space where we see more buoyancy rather than the crapped out space.
The Indian consumer play clearly seems to be moving out of FMCG and it has moved into telecom and media. As a house, are you constructive on both these sectors, and do you think the springtime for telecom has started and good days for media companies are here to stay?
No, media, as of now, we are looking only at one company in the entertainment space, not really at the news space. There is no clarity of rules in the media space as to for how long people can advertise in, let's say, a given hour. So that's a challenge, but yes, media, entertainment, broadcast space is something we are positively inclined towards. What we are most excited about is the fact that while advertisements continue to be buoyant, and while they may take a breather for some time, the carriage fees may actually go down over a period of time, and subscription revenues will look up. Both of them, improve the one improves the cost structure quite a bit. The other gives long-term stability and visibility to earnings. So if overall the volatility of earnings reduce, the discount rate that the market applies to future earnings would go down, and that really is the reason why the space has been doing quite well, and we expect it to continue to do well. Telecom is a very, very challenging space. There is a constant play between telecom and internet, while telecom companies own both the assets, but if you look at the pricing of voice is way higher than the way internet is priced. So as people get savvier, as people start to carry smartphones, to keep charging a rupee on voice would tend to become more and more difficult. So that is our concern on telecom, plus the fact that over the next 2 to 3 years, most of the current bit of licenses would have to be renewed, and that will actually stress out the balance sheets more than what they are today. So yes, while the space is getting some bit of pricing power back, we are not too positive on this space.
What about IT, Prateek? We've seen solid quarter numbers coming in from Cognizant, great guidance at that as well. Do you think that is going to augur well sentimentally for the entire IT pack? And if that were the rationale, what's it that you like from the IT space?
We like this space. It benefits from the environment as well, plus the fact that demand is definitely starting to move up. While there are concerns on the visa regime and the fines that some companies may have to pay, but overall the demand environment is good, currency is in favor, cost pressures are low. So that's a space that looks attractive to us. If you look at the overall makeup of this space, the valuations the space can have, given the quality, the ROCs that the businesses generate, can be significantly higher. It is just constrained by the long-term growth outlook that the market has on this space. So from a 10% volume growth that market believes this space will deliver, if it moves up to let's say 15% kind of a volume growth, and that's possible. That's not completely impossible. The change in valuations can be very, very significant.
Prateek, but can IT stocks do well even if rupee stays, let's say, between 60 and 62?
Oh yeah, that's a sweet spot. See, my sense is even when rupee went to 68, people who were pricing deals would not have assumed a number higher than 58, and these guys sell dollars forward. So even when we are looking at rupee dollar at 61, 62, they are booking forward at 63 to my mind. So and given the volatility, none of the IT companies may have priced or would have priced their bids at anything over 58. So if rupee stabilizes at these levels versus whatever these guys are projecting, guiding the markets, the numbers that will come would be better. That's my sense.
How exactly are you approaching industrials and cap good stocks? Do you think the tide has reversed for quality engineering stocks, or what we are currently witnessing is more like a trading rally, more like a strong swell, nothing more, nothing less?
Well, our sense is that this is again a space where for some more time one would not see numbers coming out to support stock prices. So this is where it's a high quality space. Most of the businesses are very good, cash on books, high ROCs, good entry barriers. So all of that is there, but the problem is that orders are not happening. Would orders happen in the near term? Once again, the sense is probably no. So one idea is to look at which are the spaces orders may happen. So we did interact with a lot of these companies. So one space where orders may happen is frankly the freight corridor happening between Delhi and Mumbai or Gujarat. That's a space where new locomotives, new power equipment, etc. would be put into place. So there's some bit of traction there. So businesses which can offer that, they have a global product base where from they can source those and supply, is one area of interest. There is a lot of spend going on in achieving grid stability. So there are some of the Indian names may not be able to compete in that part of the market. There the competition is significantly lower. Only the better Indian names and some of the MNCs can compete. So that's again an area to focus on. Lastly, we are probably looking at 2 UMPPs getting bidded out over the next 3 to 4 months. That's in the realm of possibilities, and given the rules, it will have to be sourced from people who have put in place manufacturing facilities in the country. So it is almost becoming a 2 or a 3 horse play for close to an 8,000 odd megawatt of bidding that may happen. So that again, gives some better visibility, at least in terms of order book, to some of these plays. So we were not looking into this space. We have started to look here, but let's say just peeking in this space rather than going full